They didn't ring a bell when it started. There was no breaking news headline, no emergency press conference. Just a quiet line in a World Gold Council report. In 2022 and 2023, the world's central banks had bought over 2,000 tons of gold. Not miners, not hedge funds, not YouTube traders. Central banks. And then 2024 arrived, and the buying didn't slow down at all. By the end of the third quarter, they had added roughly another 1,050 tons, already on pace to cross 1,000 tons again for the year. If this were just a story about price speculation, it would be interesting. But this isn't speculation. Central banks are not teenagers chasing a meme stock. They don't panic buy because they watched a viral clip about inflation. They don't FOMO into an asset because the chart looks exciting. These are the institutions that sit at the top of the monetary food chain. They see information you and I never will. Their reserve decisions are the product of teams of economists who have spent careers studying every currency collapse from ancient Rome's debasement of the denarius to Argentina's latest peso crisis. They get daily reports on capital flows, trade settlements, sovereign debt rollover schedules, and geopolitical flashpoints, much of it classified. They have intelligence agencies whispering in their ear about what rival governments are planning to do next. So when that level of player, all the way from the People's Bank of China to the Reserve Bank of India, from the Central Bank of Russia to the National Bank of Poland, from Turkey to Singapore to small countries most investors couldn't find on a map, starts doing the same thing at the same time, it is not diversification. It is preparation. They are quietly sliding out of the current game before the rules change. The question is, preparation for what? The answer, if you follow the pattern, is brutal in its simplicity. They are preparing for a world where the US dollar is deliberately devalued, where trillions of dollars of unpayable debt are wiped out the old-fashioned way, not with an announcement of default, but with a stealth reset of what money itself is worth. The tool is as old as modern finance: currency destruction through gold revaluation. It's the same basic playbook Franklin Roosevelt used in 1933. And this time, you're going to watch it in real time, not as a paragraph in a history book. Before we get to the mechanics, you need to see the scale. According to the World Gold Council's own data, central banks bought 1,036 tons of gold in 2022 and 1,037 tons in 2023. As of the third quarter of 2024, they had already taken down another 789 tons, with the final quarter likely to push the tally over 1,000 tons again. That would make 3 consecutive years of 1,000-ton buying. Before this era, the all-time record for central bank purchases was 656 tons in 2018. And for decades, after the 1960s, most central banks were actually net sellers, not buyers. To find anything remotely comparable in size and intensity, you have to rewind the clock back to around 1950, when the post-war Bretton Woods system was still being cemented, and nations were rebuilding gold hoards to anchor their new peacetime currencies. We are back in that kind of territory now, except this time the system being prepared is not being born, it's being replaced. The volume is shocking, but the cast of characters is even more revealing. Start with China. Officially, the People's Bank of China reported adding 62 tons of gold in November 2023 alone, and then logged 18 straight months of increases through May 2024. And then, just as quietly, they stopped reporting. They didn't stop buying, they stopped telling the world what they were buying. Analysts who track import flows through Shanghai and Hong Kong, mine output, and changes in reported reserves estimate that China has added at least 300 to 500 tons of gold to its official pile over the last 2 years. But that's only the part they choose to show. Beneath the surface, a parallel accumulation program hums along. State-owned enterprises, the state administration of foreign exchange, sovereign wealth vehicles, and shadowy investment funds buy bullion that never appears in the IMF's reserve statistics. It is held off the books, ready to be reclassified as official reserves the moment Beijing decides it is useful. When you roll all of those channels together, the real figure for China's gold intake since 2022 is probably not a few hundred tons, but something between 1,000 and 2,000 tons. That is the kind of stockpile you build when you are not just hedging a currency system, you are planning to outlive it. Russia tells a similar story, but with the volume turned up. In 2022, while under the heaviest sanctions regime any major economy has faced in modern times, the Central Bank of Russia bought roughly 330 tons of gold, making it the single largest official buyer on the planet that year. They kept adding in 2023 and 2024, even as their access to Western capital markets was being choked. On the surface, that sounds paradoxical. Why would a sanctioned country, cut off from global finance, shovel scarce resources into inert metal? The answer sits in one brutal moment, the day the West froze about $300 billion of Russia's dollar assets. Those reserves, treasuries, bank deposits, securities that Moscow had considered untouchable vanished with a keystroke. If you are any other government watching that happen, the lesson is instant and unforgettable. China, holding more than $1 trillion in U.S. treasuries, does not need a policy paper to imagine what happens to its savings if a crisis erupts over Taiwan. The answer is nothing at all stands between them and the same fate. Once the precedent is set that reserves can be turned into political hostages, the game changes. You no longer treat dollar assets as risk-free. You treat them as negotiable, contingent on staying in Washington's good graces. And so the quiet decision spreads from capital to capital. Don't hold what your adversary can freeze. Hold what no one can touch. Gold fits that role perfectly. Physical bars sitting in a vault in Beijing or Moscow or New Delhi cannot be seized by sanction or court order. They are not numbers in a foreign bank's database. They are literal metal under your own guard's boots. Today, Russia's official holdings sit around 2,133 tons, roughly a quarter of its total reserves. That is a higher gold share than even the United States, which, at the official statutory valuation, has about 23% of reserves in gold. Russia is more gold-heavy than America, not by accident, but by design. This is a country that has already lived through the collapse of the Soviet ruble, through hyperinflation, through Western financial warfare. They are not buying gold because it looks like a hot trade on a chart. They are buying it because they expect a world in which paper promises, especially dollar promises, simply stop mattering, and metal is the only thing left that does. India tells a different version of the same story. The Reserve Bank of India doesn't make giant, splashy purchases the way Russia does. It moves in a slow, almost metronomic rhythm. 33 tons in 2022, 41 more tons in 2023, more additions every quarter after that. None of those numbers will dominate a headline on their own, but the pattern matters: steady, unbroken accumulation. Officially, India now holds around 841 tons of gold in its reserves, but that is just the government's share. Sitting in bank lockers, family trunks, temple vaults, and wedding jewelry boxes across the subcontinent is a private hoard unlike anything else on Earth. Estimates suggest Indian households collectively own 25,000 to 30,000 tons of gold, more than the United States government, more than China, more than every central bank on the planet combined. That obsession is not superstition. It is memory. The rupee has been devalued and redenominated multiple times. Older generations still remember the silent theft of purchasing power, the way savings held in paper melted while gold bangles and coins quietly kept their value. In India, you don't need a PhD in economics to understand currency risk. Your grandmother will explain it over tea. When the Reserve Bank of India adds gold to its reserves, it is not introducing a new idea to the culture. It is aligning official policy with what Indian families have instinctively done for centuries: trust metal more than promises. Then there is Poland, a mid-sized European economy that, on paper, should feel safe inside the umbrella of the European Union and NATO. Yet, the National Bank of Poland has been acting as if the global monetary weather is about to turn violent. Between 2022 and 2023, it bought roughly 130 tons of gold, boosting its holdings from 229 to 359 tons in just 2 years, a 57% jump. Central Bank Governor Adam Glepinski did something unusual for a policymaker. He told the blunt truth in public. Gold, he said, is the ultimate safe asset, and Poland is preparing for a less stable global monetary system. Coming from a country that spent the last century being carved up, occupied, and whipsawed by hyperinflation and currency reforms, the subtext is obvious. Warsaw has no intention of trusting the future solely to Brussels or Washington. It wants something tangible in its own vaults for the day when paper arrangements begin to fray. Turkey operates on the front line of what happens when a currency already begins to unravel. The Turkish lira has staggered from crisis to crisis, losing the majority of its value against the dollar in just a few years. In 2022, official inflation blew past 80%. Prices in Istanbul supermarkets changed not yearly, but monthly, sometimes weekly. Ordinary Turks rushed to convert paychecks into whatever they thought might hold value: dollars, euros, and especially gold. Their central bank behaved the same way, adding roughly 160 tons of gold in 2023 alone. When you live inside a currency collapse rather than reading about one, gold stops being an investment theme and becomes survival strategy. The Turkish central bank knows that the lira's story is not unique. It is a preview of what happens when debt, money printing, and loss of confidence collide. And then there is Singapore, the quiet overachiever of global finance. The Monetary Authority of Singapore doesn't hold press conferences bragging about gold purchases. Its moves show up in IMF data and occasional reserve updates. A significant, carefully timed increase here, another one there. Singapore manages one of the most sophisticated sovereign portfolios in the world. It is hypersensitive to risk, allergic to political grandstanding, and famously conservative. When that kind of institution increases its gold allocation, you should hear a siren in the background. Singapore doesn't chase narratives, it front-runs structural change. Step back from the individual stories, and a single pattern emerges. Russia, punished by sanctions. China, wary of having its savings frozen in a Taiwan crisis. India, with ancestral memories of currency debasement. Poland, squeezed between great powers. Turkey, living through inflation in real time. Singapore, reading the spreadsheets. Nations with wildly different cultures, alliances, and interests are all making the same move, converting a growing share of their reserves from dollar promises into physical metal. They are not coordinating their politics, but they are converging on the same conclusion about the monetary system. It is moving toward an endgame, and gold is the bridge that will carry them to whatever comes next. What is driving that urgency isn't only fear of inflation or debt, it is the way the dollar itself has been used as a weapon. For decades, the United States could enforce its foreign policy not just with aircraft carriers, but with bank wires. Step out of line, and Washington could cut your banks off from the dollar clearing system, block your access to SWIFT, freeze your reserves, or sanction your elites.
As long as everyone needed dollars to buy oil and settle trade, there was no real alternative. Countries grumbled, but they complied because the costs of defiance were catastrophic. Over time, however, that strategy created its own backlash. Every time a new sanctions package was announced, finance ministers in other capitals took notes. They began to ask a dangerous question. What if we didn't need the dollar at the center of everything? The answer has been taking shape, quietly, under the banner of BRICS. Originally just an acronym for Brazil, Russia, India, China, and South Africa, BRICS has evolved into a loose but potent coalition, representing roughly 40% of the world's population and about a quarter of global GDP. Starting in 2022, its members began openly discussing a shared, gold-backed trade currency, designed not for tourists or retail use, but specifically for settlement between states. In August 2023, at the BRICS summit in Johannesburg, that idea took a step closer to reality when the bloc invited 6 additional countries: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates to join. Not all of them have finalized membership, but the direction is unmistakable. This is not a club of marginal economies. These are major commodity exporters, energy powers, and regional heavyweights. Together, they are laying the plumbing for a parallel financial system, a network of payment rails, clearinghouses, and credit lines that do not depend on the dollar, do not route through New York or London, and cannot be shut down by a U.S. Treasury press release. At the heart of that system sits gold. The concept is simple, even if the implementation is complex. Each participating country contributes a portion of its bullion reserves to a shared pool. That pool backs a new unit of account, a BRICS trade currency that exists primarily for settling cross-border transactions among member states. When China buys oil from Russia, instead of wiring dollars through Western banks, it transfers BRICS units backed by physical gold. When India imports soybeans or iron ore from Brazil, payment happens in the same currency. If Saudi Arabia fully joins and begins selling oil to China or India in BRICS units rather than dollars, the symbolic impact would be enormous. For the first time since the 1970s, the world's most important commodity would be widely priced in something other than the US dollar. To understand why that matters, you have to remember how the petrodollar was born. After the chaos of the early 1970s, Nixon closing the gold window, the dollar depegging from bullion, inflation spiking, Washington made a simple but brilliant deal with Saudi Arabia in 1974. Riyadh would price its oil exports exclusively in dollars and recycle its surplus petrodollars into U.S. assets. In return, the United States would provide military protection and political backing. Once that arrangement was in place, every country on Earth that wanted to buy oil needed dollars first. That constant global demand for dollars allowed the U.S. to run deficits, export inflation, and expand its money supply far beyond what any other nation could safely do. But what the petrodollar system gives, it can also take away. If Saudi Arabia starts to consistently accept yuan or a BRICS gold-backed currency for oil, as it tentatively did in March 2023 when it completed its first oil sale to China in yuan, the structural demand for dollars begins to erode. Other producers and consumers watch and adapt. Russia and India are already settling energy trade in rubles and rupees. China and Brazil use yuan and reals.
Southeast Asian nations are building their own regional settlement mechanisms that bypass the dollar entirely. Each of these steps is small on its own. Together, they're like strands in a rope being cut one by one. The petrodollar's grip loosens, and the question shifts from why would anyone move away from the dollar to why would anyone keep all their savings in a system whose dominance is visibly fading? This is the backdrop against which central banks are hoarding gold at post-1950 records. They see the dollar's network effect weakening. They see alternative rails being built. They see a future where a BRICS trade currency, anchored in bullion, starts to siphon off 10, 20, maybe 30% of global trade flows. And they know what happens to a reserve currency when demand for it suddenly drops while the issuing country is sitting on tens of trillions in debt. The math stops working. Something has to give. The United States will not choose formal default. It will choose something far more subtle and politically palatable, a controlled demolition of the dollar's real value disguised as a return to sound money. How do you simultaneously claim to strengthen a currency and yet quietly slash its purchasing power? How do you erase tens of trillions in obligations without ever declaring bankruptcy? That is where the gold revaluation playbook comes in, and that is the part of the story we turn to next. To understand why that controlled demolition of the dollar is not just possible but likely, you have to look at the numbers printed in the fine text of U.S. balance sheets. On paper, Washington owes roughly $37 trillion. The debt-to-GDP ratio sits around 130% and is climbing, not falling. The annual interest bill is already above $1.2 trillion, more than the country spends on its military, more than Social Security, more than any other single line item. That interest cost has to be paid before a single road is repaired or a single soldier is paid. You don't need a doctorate to see where that road leads. You cannot realistically tax your way out of a hole that deep without breaking the economy. You cannot grow your way out when debt is compounding faster than GDP. You cannot cut your way out when the interest bill alone is swallowing 5% of national output. So policymakers face a brutal arithmetic. Admit default outright, which would detonate the global financial system, or default quietly by paying creditors back in a currency that is worth far less than the one they lent. History shows they almost always choose the second option. But in a world where inflation is already politically toxic, they need a way to disguise that devaluation as something noble, disciplined, even conservative. That is where gold revaluation becomes the perfect costume. On the surface, America looks gold-rich. The U.S. officially holds 8,130 tons of bullion, about 261 million ounces, in places like Fort Knox and the New York Fed's vaults. At today's market price, roughly $2,700 an ounce, that hoard is worth around $700 billion. But on the government's books, that same gold is not valued at $2,700. It is still carried at the old statutory price of $42.22, a relic left over from the early 1970s. At that price, the entire hoard is worth about $11 billion. In other words, the U.S. is sitting on a gigantic unrecognized gain, hundreds of billions of dollars of hidden equity that can be conjured into existence with a single legal stroke, changing the official price of gold. Imagine the script. After a sharp fall in the dollar, rising inflation, and a series of crises of confidence, the Treasury and Federal Reserve step in together. They announce that to restore trust and discipline, the United States is returning to a form of gold backing. Not a 19th century gold standard where every dollar is redeemable on demand, but a partial, symbolic backing. Perhaps they declare that 20 or 25% of the money supply will be anchored by the nation's gold reserves. It sounds responsible. It sounds like sound money. Gold enthusiasts cheer. Headlines talk about a new era of fiscal sanity. But here is the catch. With M2 money supply sitting around $21 trillion and official gold valued at only about $700 billion at market prices, the backing ratio today is pitiful, about 3 to 4%. To make any claim of meaningful backing, they have to change the gold price, not the quantity of gold. If they revalue bullion from the statutory $42.22 to, say, $20,000 an ounce, the math flips instantly. Those same 261 million ounces become worth over $5 trillion on the government's books. Suddenly, the US can claim that a quarter of its money supply is supported by real physical metal. On paper, the dollar has been strengthened. In reality, the dollar has just been marked down by nearly 90% against gold. If gold trades at $2,700 today and is revalued to $20,000 in such a move, that is a more than seven-fold increase in the metal's price, or, from another angle, an 87% loss in the dollar's purchasing power against a hard asset. The $37 trillion in federal debt is still $37 trillion in nominal terms, but it is now denominated in a currency that buys far less. In real, inflation-adjusted terms, the burden shrinks to something like $4 or $5 trillion. Without paying back a single extra dollar, the government has silently erased over 30 trillion of obligations. The losers are the people and institutions who hold those dollars and bonds: foreign central banks, pension funds, insurance companies, retirees, savers. The winner is the issuer of the currency, which has just stolen purchasing power through a return to discipline. If this sounds like a conspiracy theory, remember that America has already run this play once. In 1933, with the Great Depression grinding on, unemployment at 25% and banks collapsing, Franklin Roosevelt reached for the same lever. First, he ordered citizens to hand over their gold under threat of fines and imprisonment, compensating them at $20.67 per ounce. Most obeyed. They trusted the government and feared the alternative. Once the gold sat safely in federal vaults, Roosevelt raised the official price to $35 an ounce in 1934, a 69% jump. Overnight, the value of the government's reserves ballooned, and the real burden of its debts shrank. The dollar was devalued, but the move was sold as necessary medicine. Ordinary Americans, who had just swapped their metal for paper, discovered that the asset they were forced to surrender had been repriced far higher, locking in their loss for the next 4 decades, while private gold ownership remained illegal. Central bankers around the world know this history by heart. They study it in internal memos and graduate seminars. They understand that revaluation is not some fringe idea, but a tested tool. That is why they are not looking at today's gold price and asking, is it expensive? They are asking, where will it be when the next revaluation comes? If you expect a future where bullion is officially marked at $10,000 or $20,000 an ounce to patch government balance sheets, paying $2,000 or $2,700 today looks less like speculation and more like buying into a rigged but predictable game before the rules change. Their conviction doesn't come only from history. It comes from 3 forms of intelligence that ordinary investors never see. First, capital flows. Central banks track in real time how much money is rushing into or out of different assets and currencies. They know exactly which countries are dumping U.S. Treasuries and which are quietly building positions in euros, yuan, or gold. IMF data already shows the dollar's share of global foreign exchange reserves sliding from about 61% in 2020 to around 58% in 2024. 3 percentage points may sound trivial, but when the base is tens of trillions of dollars, it represents hundreds of billions quietly rotating away from dollar assets. That is the early stage of a run, not a panicked stampede yet, but a steady, deliberate exit by the insiders. Second, they see the geopolitical briefings that never make it to public news feeds. The People's Bank of China is not guessing about the risk of conflict over Taiwan. It is plugged directly into the thinking of China's military and political leadership. The Federal Reserve hears the classified assessments of the NSA and the Pentagon. The Bank of Russia hears FSB reports. These institutions don't have to speculate about whether sanctions might expand, whether shipping lanes might close, whether a regional war could ripple through energy markets. They receive probabilities, scenarios, and contingency plans. And in almost every scenario where tensions escalate, dollar assets held abroad become targets. Assets to be frozen, payment channels to be cut off,
reserves to be weaponized. Third, their internal economic data is sharper than anything in public data sets. They track wholesale prices, real-time shipping costs, corporate balance sheets, and monetary aggregates with a granularity the public never sees. They watched M2 in the United States explode by 40% between early 2020 and 2022. They have models showing how that surge in liquidity will eventually bleed into goods, services, and asset prices, even if headline CPI numbers are massaged lower by changing baskets and hedonic adjustments. They know that you cannot conjure trillions of new dollars into existence and then pretend nothing permanent is changed. At some point, the bill arrives in the form of much higher inflation or a crisis of confidence, or both. When you combine those three lenses, capital quietly fleeing the dollar system, rising geopolitical risk around the weaponization of reserves, and an internal recognition that inflation pressure is structurally baked in, the logic of central bank gold buying stops being mysterious. It becomes inevitable. They are not betting on a trade. They are shifting from a depreciating claim on someone else's promise to an asset that stands outside the system entirely. And they are doing it on a timeline. Phase 1, the one we are living through now, is the quiet accumulation from 2022 through mid-2025. 1,000-ton years of buying, financed in part by selling down U.S. Treasuries. Phase 2 is the open challenge, the launch of a BRICS gold-linked trade currency and the visible erosion of the petrodollar's monopoly between 2025 and 2026. Phase 3 is the reckoning, somewhere in the 2027-2028 window, when the United States responds with its own gold revaluation to shore up a falling dollar and an unpayable debt mountain. When that happens, the world will be divided into two camps: those who entered that storm holding metal, and those who entered it holding promises written on paper that suddenly buys much less than anyone expected. That is the world central banks are preparing for. The only remaining question is how individual investors, people without vaults, without intelligence briefings, without a seat at the BRICS table, choose to respond while there is still time to move. Most people hearing this story for the first time ask the same question. If central banks are this worried about the dollar, why is their answer so focused on one ancient heavy metal? Why not diversify into tech stocks, New York real estate, or even Bitcoin? The answer is that gold sits in a category of its own. Every other asset is ultimately a claim on somebody else's promise. A bond is a promise from a government. A stock is a promise from a company. A bank deposit is a promise from a bank. Those promises can be broken, inflated away, taxed, defaulted on, or frozen. Gold is different. Gold is not a promise. It is a finished result. It doesn't need anyone's balance sheet to exist. It doesn't need a central server, a court system, or a functioning stock exchange. It just lies there, an inert element that human beings across 5,000 years have agreed represents stored effort. That is why, whenever currencies fail, Weimar Germany in the 1920s, Argentina in the 1980s, Zimbabwe in the 2000s, the people who walk through the wreckage with their purchasing power intact are the ones who entered the crisis holding metal, not paper. For central banks, there is another layer. Gold is one of the only assets that is both politically neutral and universally recognizable. Russia may not want to hold dollars if it expects sanctions. China may not want to hold euros if it expects European hostility. India may not want to hold yuan if it fears Beijing's influence. But all of them will accept gold from one another. An ounce from a Russian vault is identical to an ounce from a Canadian mine or an Australian refinery. It does not carry the flag or the legal system of any particular country. That neutrality matters in a world where alliances are shifting and where the global trading system is quietly fragmenting into rival blocs. If you are designing a backup monetary system that can survive those fractures, you need an anchor that neither Washington nor Beijing can unilaterally control. Gold is almost the only candidate. Then there is the question of digital risk. Over the last decade, trillions of dollars have moved into purely digital forms of wealth: cryptocurrencies, tokenized assets, fully online brokerage accounts. At the same time, cyber warfare has become a standard tool of statecraft. North Korean hackers drain crypto protocols. Ransomware gangs shut down hospitals and pipelines. Intelligence agencies poke constantly at one another's financial infrastructure. In that environment, a reserve asset that lives entirely on a network is an attractive target. Flip the right bits in the right database, and a fortune vanishes. Central banks know this. They run red team exercises where their own systems are attacked to see what breaks. Again and again, they come back to the same conclusion. The only asset that cannot be deleted with a keystroke is the one that is not on the network at all. Physical gold in a hardened vault is inconvenient, heavy, and old-fashioned. That is exactly why it is so valuable in a crisis. And looming over everything is inflation. In the 1970s, when the United States broke the last link between the dollar and gold, inflation surged. Official prices roughly doubled. Unofficially, the cost of living felt like it tripled for many families. In 1971, gold traded at $35 an ounce. By 1980, after a decade of monetary experimentation and geopolitical shock, it touched $850. While stocks churned sideways in real terms and bonds were pulverized, gold multiplied wealth for those who had it. Central bankers look at the 1970s and then at today's chart of debt, deficits, and money supply growth, and they see a rhyme that is hard to ignore. The 2020s are more leveraged, more globalized, more digitally fragile. If inflation was the side effect of far smaller experiments in the past, what will the side effects be this time? That is why they are not waiting for the CPI to admit the problem. They are preparing for the kind of inflation that rewrites contracts and careers. For you watching this from the outside, the uncomfortable truth is that you do not get the memos, you do not attend the closed-door briefings, and you do not control the levers. But you do get to decide what you hold when the music stops. Buying an ounce of gold today is, in a sense, a vote of confidence in the idea that the people running central banks are not clueless. It is a bet that their trillion-dollar allocation decisions are based on information and models more robust than any retail YouTube channel or any government press conference.
If they are wrong, and the next decade is peaceful, low inflation, and stable, then gold may simply grind sideways while other assets outperform. If they are right, and a revaluation pushes bullion towards 10,000 or 20,000 ounces, today's prices will look, in hindsight, like a clearance sale before the doors were locked. The timing of that shift usually follows a familiar pattern. First comes the smart money phase. That is where we are now. Central banks, sovereign wealth funds, and a small circle of ultra-wealthy families accumulate quietly. They do not advertise their moves. They report them late, if at all. China buys through opaque state entities. Russia settles trade in bullion instead of dollars. India's central bank adds a few dozen tons each year without fanfare. This phase is almost always invisible to the average person because nothing dramatic is happening on the price chart yet. Phase 2 is when the institutions that manage other people's money finally wake up. Pension funds, university endowments, large hedge funds. These players are not allowed to act on intuition. They need trends, data, and consultant reports to justify changes. When gold has already moved substantially and central bank buying is widely reported, they begin to shift a few percent of portfolios into bullion or miners or gold-backed ETFs. Financial media starts to run serious segments asking whether gold should be part of a balanced allocation. Price moves become sharper. Pullbacks are bought. In this phase, the narrative changes from gold is a relic to gold is a necessary hedge. If we are not already in the early innings of that phase, we are very close. The final phase is the one that always arrives last and always arrives loudest: retail mania.
This is when billboards on highways advertise gold coins, when shopping mall kiosks sell tiny wafers in glossy packaging, when friends who have never read a balance sheet start asking which gold stock to buy. Television hosts talk about protecting your savings with late-night bullion offers. Call centers ring phones with limited-time deals. At that point, the big central banks and the earliest smart money are not buying anymore. They are distributing to the public. They shifted out of paper promises when gold was boring and unloved. The crowd rushes in when the story is irresistible and the price parabolic. History suggests that the greatest fortunes are not made in that last phase. They are merely transferred from the latecomers to those who got there years earlier, quietly, before the headlines. Where we stand today is somewhere between the end of Phase 1 and the beginning of Phase 2. Central banks have declared their intentions not with speeches, but with thousands of tons of metal moved into dark, silent vaults. The institutions are starting to notice. The public, by and large, is not. Most people are still all in on the assumption that what worked for their parents, index funds, bond ladders, a paid-off house, will work unchanged in a world of weaponized currencies and rolling sovereign debt crises. Maybe they are right. But if the pattern of history holds, the sacrifice that fixes today's problems will be invisible, indirect, and borne by those least prepared. Savers whose money is measured in units that quietly lose their meaning. This is not a call to panic or to bury bars in the backyard. It is a call to see the pattern clearly and to respond with intention instead of shock. Empires rise and fall. Reserve currencies come and go. The people who live through those transitions with dignity are not the ones who guessed every twist correctly. They are the ones who refuse to leave their entire future in the hands of distant institutions. Diversifying out of pure paper, lowering personal leverage, understanding what you own and why you own it, those are acts of self-defense in a system that is rearranging itself. Gold is not a magic answer, but in the eyes of the institutions that quietly run the monetary game, it is the asset you reach for when you know the rules are about to change. When historians look back on the 2020s, they will see more than lines on a chart. They will see the moment when a century-old monetary order began to crack, when nations that had grown comfortable at the center of the system tried to print away the consequences of decades of excess, and when others, tired of being on the receiving end of that policy, quietly picked up the only neutral collateral left on the board. Somewhere in that story will be millions of individual decisions, some who saw the pattern and adjusted, some who trusted the old narrative until it was too late. You cannot choose how the script of global finance ends, but you can choose whether you walk into the final act holding only paper promises or something that has outlasted every empire that tried to debase its way out of trouble.